We talked about historical, now we talk about forward-looking estimates, and all this should look familiar. Forward-looking estimates are logically more appropriate. Why? Because the ERP is based on expectations for economic and financial variables from the present going forward. So with historical estimates, you are obviously constrained by what happened. And if you believe that like if you were sitting in India in 1991, you know that the economy has structurally changed. So does it make sense to use historical numbers or forecasts of moving forward? So it makes more sense to have a forward looking. So generally this is preferred. What does ex ante mean? What you are expecting or anticipating. Estimates are likely to be less subject to an issue such as non-stationary data or data biases. Okay, so that's another advantage of using forward looking. But what's the drawback? There can be other potential errors. So how sure are you that your estimates are good? How sure are you that your models are good? You might be overly confident, which might introduce behavioral biases. Okay, now this will look somewhat familiar. What are the main approaches for coming up with your equity risk premium? One is the Gordon growth model, which you should know. And then there are macroeconomic estimates and survey estimates. I'll spend time on 1 and 2. Survey estimates is the simplest. All you do is ask a sample of experts about their expectation about the equity risk premium. So this is what I did in Pakistan. So if I am teaching a course and I need to get a sense for what the equity risk premium is, I ask the head of research at all the top brokerage firms and I get an average number of about 6%. So that means that the equity risk premium in Pakistan is about 6%. Okay, that method works. Okay, but not very testable. So you need to know 1 and 2 also. 1 you already know. So the Gordon growth model, it's based on the assumption that dividend payout shall remain constant, earnings will grow at a constant rate. So your risk premium is effectively your dividend yield plus the long-term earnings growth rate. So effectively this is your, this looks a lot like this, your return is equal to D1 over P0 plus G. Okay, what's D1? This is sort of your overall market dividend yield. The P0 is the market price level, and G is the earnings growth, and your earnings growth is simply a proxy for the dividend growth. So you are simply applying the Gordon growth model to the overall equity market. Okay, just to give yourself a break from listening to me, do this problem over here. If you can't do this, I'd be very concerned. Okay. All right. So there is not much to it. So the dividend yield 1.9%, that's right here. The market's consensus earnings growth are 7%, and the okay, yeah, here I just so do you actually do you see this over here? That's your return is 1.9 plus where's the 7% coming from? That's the growth. So that's this is like your D1 over P0. That's your growth. And why are you subtracting the 5%? Because we are looking at the equity risk premium. So you need to subtract the risk-free rate, and notice that this is the long-term bond. Okay, now what about macroeconomic models? So just stay with me here. We talked about, just to keep you on track, 3 models or 3 ways of estimating forward-looking ERPs. One was the survey method, which is easy but non-testable. Second was Gordon growth, which we've done, and the third is macroeconomic models. What do you think this is based on? Macroeconomic variables, all right, and the financial variables in equity valuation models. Now, this is perhaps the first thing in today's lecture that you need to memorize, and there are questions at the back on this. So the equity risk premium is based on the expected inflation, which is a macroeconomic variable, expected growth in real earnings per share. Why do we say real? Because we've already factored in the inflation. The expected growth in price earnings. Okay, if you are expecting PE ratios to go up, what do you think that will do to the equity risk premium? It will increase. Okay, plus 1 times the expected income component, that's your dividend yield, minus the expected risk-free rate. Okay, this will give you your equity risk premium based on a macroeconomic model. So make sure you know this. There are questions at the back on this. Let's just plug in some numbers. If you are in an environment where the expected inflation is 1.25, so that becomes 1.025 multiplied by the real EPS 1.03, PE 0. So what do you multiply by? Simply multiplied by 1, and you are given the expected income component is 1.2%, is 2.2%, 0 to 2. Okay, so you multiply all these out, and then when you subtract, so you multiply these and then you subtract 0.05, you will get 1.028. So what does that mean? What does that say about the equity risk premium? The equity risk premium is 2.8%. So it's simple, but you need to know this. So if you are watching this video, just pause and memorize this formula. Okay. Now that we've talked about equity risk premium, we are going to talk about the section 4, which is the required return on equity. Here is what you've seen already. There are 3 ways of doing this. CAP-M is what you've done before. Now that you are bigger boys and girls, in level 2, we will talk about multi-factor models. So the pricing depends on more than just the equity risk premium and beta. So we'll talk about multi-factor models, build-up models, and so on. Okay, but to warm you up, we will show you what you already know. So the expected return, actually, why does it say this? In equilibrium markets, the expected return on an asset is given by the CAP-M formula. So this is your required return. In an equilibrium market, the required return and the expected return are the same. Okay, what is the underlying assumption? Investors are risk averse, and that they make investment decisions based on the mean return and variance of their portfolio. So you've seen all this before. I'll not make you do this. If you are just trying to recall CAP-M, then you can just pause here and quickly apply the CAP-M. Okay. How do you estimate the beta for a public company? Since CAP-M uses beta, we need to figure out the beta. So one way of coming up with the beta is to say it's the covariance of the returns of the stock versus the return of the market divided by the variance of the market returns. The other way of looking at it is beta results from an ordinary least squares regression. So that's the regression that we did in quant of the return on the stock against the return on the market. If some of you joined in late and have not done quant yet, it's not a big deal. You know, you don't really need quant to be able to do all this. But just very briefly, what's happening here is you plot the you do a return on market versus return on a given stock, come up with a scatter plot, and then when you draw a regression line, the slope of this regression line is the beta of a stock. So this regression line will have the form Ri, so y is equal to mx plus c. So the alpha is this intercept, which we are not worrying about right now. The beta is the slope, that's what we are concerned with. Okay, beta estimates from above, and this is now, up till here, hopefully it was familiar, this is new. The beta estimate that you come up with from this sort of an analysis is called an unadjusted beta. Okay, but Beta estimate is influenced by the choice of the index. Okay, so which index do you use here? In Pakistan's context, do you use the KSE 100 or the KSE 30? In the US, do you use the Dow Jones, the S&P 500, NASDAQ? So obviously the beta will be different slightly depending on which index you use. And then what's your data frequency? What's the length of data? So all these little variables will create different estimates of beta. Okay. We are not really going to solve these problems. You just need to know that this is statistics and they will be, and it's not a perfect world, but these are the issues that exist. From a testability perspective, you need to know the following. That whenever you estimate the beta of a stock, let's say you come up with a beta of 1.3. Betas over time, so this is based on historical data or forward-looking data? This is based on historical data. Moving forward, betas tend to move towards a beta of 1. If the beta is too high from historical data, it will come down. And if beta is very low, it will tend to move up. So you can think of it as being mean reverting, moving down, moving towards 1. So if you know that you found 1.3, that's the unadjusted number. How do you adjust it? You adjust it by using this formula, which is a simplistic weighted average way of moving the beta to 1. And just memorize this formula. Generally, the adjusted beta is written as 2/3 of the unadjusted beta times 1/3 of 1. 1 being the market beta. If you are given some other fraction to use, like 4/5 and 1/5, use it, but the default is to use 2/3 and 1/3. Skipping the details in a long-winded problem in the curriculum, all they do is in between a bunch of text, they tell you that the unadjusted beta is 1.57. If you know the unadjusted beta, can you find the adjusted beta? Yeah, all you do is 2/3 times that plus 1/3. So always the adjusted beta will be closer to 1 than the unadjusted beta. Okay. Next, this is something that the diligent ones among you actually figured out in corporate finance in level 1, but I know that many students passed the exam without quite doing this, but you need to know this now. How do you estimate the beta for a thinly traded stock or for a non-public company? So to do so, there is a 4-step process. Step 1 is and let me just create a simple example. Let's say that you are trying to find the beta for a thinly traded company called A. Okay, so to find the beta, the first thing you do is identify a benchmark company called B, which is a publicly traded company with a observable beta. Okay, so you select the benchmark company B, you estimate the benchmark's beta, so you come up with the beta for the benchmark, let's say that's 1.5. Then you unlever the benchmark's beta. What that means is this beta, let's say, has 60% equity and 40% debt. Does having debt in the capital structure increase the riskiness of this company? Yes. It does. So you come up with a beta that is unlevered, which is saying that what would the beta of this company be if there were no debt? What would happen to the beta? It would probably come down. I'm just making up numbers. There is a formula for this that I'll share with you, but conceptually it is lower. Then you come and look at this company. Let's say that this company is 40% equity and 60% debt. So then you need to lever up this number. So from 1.4, you lever the beta up to come up or to reflect this capital structure, and then you might get a beta equal to 1.6. Okay, how many people remember this from level 1? Okay, about 30% of you, which is fine. In level 1, most people pass without worrying about this. Okay, so in level 1 you could get by without memorizing this formula, but here when you unlever the beta, which means finding the beta assuming there is no leverage, the formula is beta unlevered, and in level 1 this was sometimes referred to as the asset beta also, okay, is equal to 1 over 1 plus the debt equity ratio. And again, the super diligent ones among you will remember that there we also had a tax rate to worry about and so on. Here, for some reason, I guess out of simplicity, the tax is removed. This is an approximation anyway. So remember this formula, 1 over 1 plus the debt equity ratio multiplied by beta equity. So this will give you an unlevered beta that is definitely going to be less. How do you know it's going to be less? Because it's 1 over 1 plus something. So the unlevered beta will always be less than the beta of the benchmark. And then what do you think you'll see next? Then the subject company, which is A, how do you lever up? Then you take 1 plus, this is the debt equity of which company? Of this A, multiplied by what's BU? The unlevered beta. So it's not that bad. In level 2 you need to know this here, and then there'll be subsequent readings where this will come up. Okay, so do this. So this company Allegheny is our benchmark. What's the beta for the benchmark equal to? 0.5. Is this the levered beta or the unlevered beta? Unlevered. There is no leverage here, so that makes our life easier. So what do we need to do? What about our company that we are trying to evaluate? So does that have leverage? So it is 20% funded by debt. So just conceptually, will the beta of that company be more than this or less than this? So yeah, so you basically say the beta levered is equal to what? What's the formula? Multiplied by? Okay, so you plug this in. What I hope you are past this. What's the debt equity ratio here? So 1.25 into 0.5, and that will give you your answer. Okay, so this is what you should get. Okay, now multi-factor models. So far, mostly what you've seen hopefully was familiar. Empirical evidence, is CAPM a single factor model? It is. What's the only factor that the required return depends on? The only thing that it depends on is the market or the equity risk premium. So then that's multiplied by a sensitivity called beta, which is specific to the stock. What multi-factor models say is that the required return depends on more than the equity risk premium. So CAPM is a one-factor model. We are now going to study multi-factor models. Why study? Because empirical evidence suggests that CAPM beta describes risk incompletely. The R squared of individual stocks, remember vaguely, I guess from quant, R squared is a measure of how well your regression line fits the data. So if the R squared is somewhere between 2 and 40%, that means that there must be some other factors that explain the return on a stock. So there might be other factors which drive returns. Okay, and the sort of models that we will look at, one is the arbitrage pricing theory, where we say that the required return is the risk-free rate plus different risk premiums. But the ones that we will focus on here are multi-factor models, and the one that you must know, or the two that you must know, are these two, the Fema-French model and the Pasteur-Stambo model. If you have trouble memorizing stuff, the one that you must know is Fema-French. Okay, and then there is a macroeconomic multi-factor model, which is, you should know, but it's less important. Okay, let's look at the Fema-French model. The seed for this model was planted in your heads when you studied equity in level 1, where there was a reading on anomalies, and what you hopefully remember from there is that it has been noticed that small companies tend to outperform large companies. Okay, so that means if small companies outperform large companies, then the then the required return on smaller companies would be more. Another way of looking at it is smaller companies tend to be riskier than larger companies, but nevertheless, if we are saying that, okay, the size of a company also has an impact on return, then clearly the size of a company should be built into the model. Another thing that you might recall is that companies with low book value to market value ratios tend to perform better than the other way around. Okay, so now how do we build that into a model? These two, famous people, Fema and French, they created this model where they are saying that the required return is equal to the risk-free rate plus this part is straight out of CAPM. It's the beta, which is the sensitivity of a stock to this RF stands for the return on the market minus the risk-free rate. So this is effectively your equity risk premium. Okay, so this part is like CAPM, and this beta, these betas are often referred to as sensitivity factors. So is beta stock specific? Yeah, the sensitivities are stock specific. All these betas are stock specific, and the factors, are they stock specific? No, the factors are not stock. And the way you can always remember that is equity risk premium stock specific. No, it's specific to that market or that economy. Similarly, all these factors are not stock specific. They are for the market where you are operating. So these numbers would be similar for the US market, as in you would have a certain RMRF, you would have a certain SMB, and so on. Okay, now let's get into the interpretation of these. RMRF is straightforward. That's your equity risk premium, return on market minus the risk-free rate. Okay, SMB is the second factor in the FEMA French model. This stands for small minus big. It's the average return on 3 small cap portfolios minus the average return on 3 large cap portfolios. So simplistically, what this is saying is we take a few small cap portfolios, okay, and look at their average return. Then we look at a few large cap and there will be a certain average return. Will this factor be a positive number or a negative number? It will be a positive number because the average return on small cap, I'll just make up some numbers. Let's say the average return on small cap is 9.4 and the average return on these 3 large cap is 8.9. Okay, so that will make this equal to 0.5. Okay, so that is given for the market. Then where will this beta come from? What will the beta size be based on? It will be based on the size of that particular stock. All right. What about HML? This stands for high minus low. It's the average return on high book to market value portfolios. So high book to market portfolio means what? It means that book value is high relative to market value. So these are the value stocks. So do you remember that value stocks, at least according to the anomalies that we studied, are tend to do better than growth stocks, or so stocks where the book to market ratio is low. So this again will be a positive number, and then the beta will depend on what? Beta again will depend on the ratio, book to market ratio of a particular stock. Okay, so now that you've understood those items, we'll just do a few questions and then end this segment. Okay, let's check your basic understanding. Try to do this problem. So you are given some data for CAPM, given some data. What does FF stand for? FEMA and French. Okay, so ignore these R squares. All they are telling you is that this is fine. So can you do the CAPM and the cost of equity or the required return based on FEMA French? Okay, so here hopefully this is what you're doing. The cost of equity is simple. That's simply the risk-free rate plus the market beta into the equity risk premium. So that's straightforward. With FEMA French, you again take the risk-free rate, and then the first part is so in this model, when you are running this sort of an analysis, you are told that the market beta is 1.14 multiplied by the market risk premium. So that's this number. The size premium, these are the factors, the ones that I've just ticked. Are these Microsoft specific or market specific? These are market specific. What does a minus number, is the minus 0.222 Microsoft specific? What does a minus number mean? This means that Microsoft is big relative to average. Right? So which we all know anyway, right? So which makes sense, because if big stocks, what was the anomaly that we talked about earlier? That small stocks give you a higher return. So that means big stocks give you a lower return. So that means that when we, so based on the size, big guys will get a minus number. Okay. What does this minus mean? That this is a value stock or not a value stock? This is not a value stock, which again makes sense because probably Microsoft has a very high market. I just find it easier to think of market value over book value, because market value generally is higher than book value. So Microsoft will have a very high market value divided by book value, which means it has a low book value over market value. Okay, now let me just the final point in this clip, the Pastor-Stambo model. Okay, this is, has everybody memorized the FEMA French now? And I'll just help you do it. So it's the beta times the market, so effectively the market risk premium or the return on market minus the risk-free rate. And then what are the two other factors? There's a factor based on size and there's a factor based on value. Okay, all this, these two smart guys, the only value addition they did is that they said, okay, let's add a liquidity factor also. Okay, obviously I'm making a small joke out of it. I'm sure they did add a tremendous amount of value, but as far as we are concerned, what we need to memorize is the only additional item is liquidity. So take a wild guess. Again, this liquidity factor will be the same for a market. So companies that are very liquid will have a small beta or a big beta. Yeah, actually liquid, very, very liquid might actually become negative. So average liquidity beta will be 0. If a stock is very illiquid, what happens to the required return? Goes up. So then beta will be high. So now let's say a stock XYZ has these characteristics. You are given the betas or the sensitivities. So what can you tell about the characteristic? Is this big, small, high market value, liquid, illiquid? So market beta of 1.5, what does this say? So it is riskier than the market. So more volatile than the market. Size beta of 1.5, of 0.15. Yeah, so it is on the small size because 0 would be average. If we have a positive number, so it is smaller than average, so this is increasing our required return. The value number is minus. It's a growth stock, so probably the market value is high relative to book value, so that makes sense. And the liquidity beta, so it's relatively illiquid. It is relatively illiquid or less liquid. Why? Because when it is a positive number means that hopefully you recognize that if a stock is not liquid, LLQ, what do you think this stands for? Lack of liquidity, I think. Okay, LLQ, lack of liquidity. All right, that means that if a stock lacks liquidity, then the required return becomes more. So a positive number means that it's relatively less liquid which makes sense. You have a small growth stock, so smaller stocks tend to be less liquid than large cap stocks. Okay, so all right, so that's it for this segment, and we will continue next time.